Hey everyone, and welcome. So, if you're an MBA student, you know that moment is coming, right? That big interview where they drop a stock ticker on the table and just say, "So what do you think?" Well, today, we're going to build the exact toolkit you need to break down any company like a seasoned pro. Let's get right into it. Okay, so picture this. You get a ticker. Let's say it's Nike. Instantly, your brain is flooded with articles, earnings reports, tweets. It's a total tidal wave of information. It is super overwhelming. But here's the secret. Cracking a stock pitch isn't about knowing every single number. It's about building a powerful, evidence-backed story. And every great story starts with one single powerful idea.
And that idea is your investment thesis. Now, if you've been in consulting, you know the answer first approach. This is basically that. It's your core argument. It's the strategic why that drives everything else. Think of it as your North Star. It's going to guide every piece of your analysis and make sure everything you do connects back to that one compelling narrative.
So, how do we build that thesis? We're going to use a really clean three-pillar framework. First, we'll give the company a financial checkup. Then, we're going to look under the hood at its business engine. And third, we'll size up its competitive moat. After all that, we'll show you how to bring it all together and wrap up with a practical MBA toolkit so you are 100% ready for that interview.
All right, let's jump into Pillar 1, the financial checkup. Look, before you can even think about predicting a company's future, you have to get a really clear picture of its health right now. And we do that by looking at its vital signs, which, in the business world, are its financial ratios.
Now, a table like this can look a little intense at first, I get it, but its job is actually pretty simple. It helps us bring order to all that financial chaos. These ratios are just tools that let us compare any company's health on a standardized, apples-to-apples basis. We can measure profitability, debt, you name it. But out of all of these metrics, there is one that rules them all. And that metric is return on invested capital, or ROIC. Honestly, forget everything else for just a second. This is the single most important test of a great business. It asks a really simple question. For every single dollar the company puts into its operations, how many cents of profit does it actually generate after paying for that capital? It is the absolute acid test for creating value. So here's the magic number you're looking for: 15%. If a company can consistently, year after year, generate an ROIC above 15%, you've just found hard, quantitative proof that a real, sustainable competitive advantage is at work. It's not just a nice story anymore. It's a fact you can see right there in the numbers.
Okay, now for Pillar 2. A high ROIC is awesome, but how is the company actually pulling it off? This is where we look at the business engine, the gears and levers inside the company that actually make the money and determine how its profits grow.
And every business engine is really just built from two basic parts: fixed costs and variable costs. Fixed costs are things like rent on a factory. They stay the same whether you sell one widget or a million of them. Variable costs, like the materials to make that widget, go up with every single sale. And the unique mix of these two costs, well, that defines a company's entire personality.
This special mix is what we call operating leverage. A company with high operating leverage relies heavily on fixed costs. Think about a software company, right? They spend a ton of money to build the software one time, but then the cost to sell an extra copy is basically zero. This leverage acts like a huge magnifying glass on their profits. And this chart just shows you the power of that. Just look at this. For the exact same 20% bump in sales, see the difference? The low-leverage company on the left gets some nice, steady profit growth, but the high-leverage company on the right, whoa, its profits don't just grow, they absolutely skyrocket. That is the business engine firing on all cylinders. So here's a really easy way to remember this. A high-leverage business is like a race car. The acceleration is just incredible. But if sales dip, you can crash and burn just as fast. A low-leverage business, on the other hand, is like a family sedan. It's reliable, it's safe, but you're just not going to get that same exhilarating upside.
Which brings us perfectly to our third and final pillar, the competitive moat. What is it that allows a company to keep generating those high returns and protect that high-octane business model? Well, it's the giant castle wall it builds around its profits to keep all the invaders, the competitors, out.
Now, before we check out the company's castle, we have to scope out the battlefield it's on, the industry itself. And for that, we use Porter's 5 forces to see just how rough the neighborhood is. Is it easy for new companies to just show up? Do customers have all the power? A really tough industry makes it way, way harder to build a moat that lasts.
So, how does a company actually build that wall? Well, it turns out there are really only 5 main ways to do it.
These are the 5 primary sources of a durable economic moat, the deep, structural advantages that are incredibly hard for anybody else to copy.
First up, you've got intangible assets. This could be an iconic brand like Coca-Cola that people trust and will pay more for, or it could be a portfolio of patents like the ones that a pharmaceutical company like Eli Lilly has that create a legal monopoly for years. Second is creating high switching costs. This is all about making it a huge pain for your customers to leave. Just imagine a big company trying to rip out all of its Salesforce software and move to something else. The cost, the time, the risk, it's just so massive that it locks customers in. Third, and this one is so powerful, is the network effect. This is where a service gets more and more valuable the more people use it. Visa is the perfect example. The more people that have Visa cards, the more stores want to accept them. And the more stores that accept them, the more people want a Visa card. It's this incredible self-reinforcing cycle.
Fourth on the list is a deep structural cost advantage, and I'm not talking about being the cheapest for a little while. I mean a permanent edge. Think about Walmart's unbelievable logistics network. They spent decades building it, and it allows them to operate at a scale and cost that nobody else can even touch.
And finally, number 5 is efficient scale. This is for markets that are basically natural monopolies, where the market is just not big enough for 2 companies to survive and make a profit. I mean, can you imagine trying to build a brand new railroad right next to Union Pacific's existing tracks? It makes no economic sense. Okay, so we've got our 3 pillars: the financial checkup, the business engine, and the competitive moat. Now for the most critical part. We have to translate all of this great qualitative analysis into a hard quantitative number, the valuation.
And the logic here flows beautifully. Your analysis of those 3 pillars directly informs the assumptions you make in your financial forecasts. For example, if you found a company has a powerful brand, that's an intangible asset, right? You can feel confident forecasting higher profit margins way into the future. And those forecasts feed right into your DCF model to spit out the company's intrinsic value.
And this right here is the magic link. This is where your story and your spreadsheet become one. Having a wide moat has a massive impact on your final number. Why? Because it's what gives you the justification to say, I believe this company can keep growing sustainably for a very, very long time. And that single assumption can radically change its final valuation.
All right, let's wrap this all up with a toolkit you can take with you. We've gone through a lot, but it really just comes down to a few core ideas that you need to nail. So, here are the 3 big takeaways. Number 1, always start with the why, your investment thesis. Number 2, a sustained ROIC over 15% is your hard proof that a moat really exists. And number 3, your story about the moat has to directly and logically support the numbers you use in your valuation. They have to match up perfectly.
Okay, and you can bet you're going to get asked questions just like these. But they're not trick questions. When they say, walk me through your process, you talk about the 3 pillars. When they ask, what is an economic moat? You name one of the 5 sources and give a great example. And when they ask about cost structure, boom, that's your chance to use the race car versus sedan analogy and talk all about operating leverage.
You've now got the framework, you've got the key metrics, and you have the narrative structure to analyze basically any company out there. So the only question left is, what company are you going to start with?